Today, I wanted to go over something that confuses a lot of business owners when they go to sell their business. And it even honestly confuses some accountants that I've seen put together business valuations, and it's not actually correct in the sense that a business owner isn't going to be able to get that price. Anyone can put together any idea of a valuation, but what are you actually going to be able to sell that for? So the thing that comes up a lot is the question, should I include my business assets in addition to the business sale price? So I'm going to walk through an example. We have a business that I just looked at that is doing 133,000 in seller's discretionary earnings. So that is, as a reminder, just the W-2 wages of the owner and any profit that comes from the business plus depreciation, any other like non-cash expenses. So the total owner benefit, 133,000. So if we do kind of a standard multiple, you might get a value of 340,000 or so. So when you go to, and the owner wanted to get a little bit more than that, even on the higher end, let's say 380. Well, now you have the 380,000 in business value, and then this business owner happens to have about $260,000 worth of equipment, and he needs that equipment in order to operate his business. It's not extra equipment. This is a construction related business. It's heavy machinery that's required for the business. So he's thinking in his mind, okay, I'm going to take the 380,000 plus the 260,000 worth of the assets that I have to equal a $640,000 business purchase price. And let me just walk through why this gets tricky. So when someone goes to get a loan on that business for $640,000, the bank is going to say, you need X dollars to live on. Let's call it $60,000. As the owner operator, you can't operate a business and have a job that pays nothing because you won't be able to pay your bills and you won't be able to pay this loan back. So let's assume you need $60,000. A buyer might need actually more than that, depending on their lifestyle and the amount of debt they have and how big their house is, etc. But let's just go with the $60,000 to just keep it simple. So if they have the $640,000 purchase price, they've got the $133,000 in earnings. That means that after they pay that $60,000 to the owner, there's $73,000 left for debt service. Now, what is that loan going to cost the new owner for a $640,000 purchase? It's going to cost $91,000 per year in loan payments. That assumes a standard 10-year SBA loan where the owner is putting 10% down. So their loan payments are $91,000. Well, remember the math that we just did? $73,000 left to pay for debt service, but their loan is $91,000. So that means they're negative $18,000. There's no way the bank is going to do this loan because they're saying the amount you have left is way lower than your actual loan payments. This would never fly. Banks want to see that you have, if you have 73,000 left, then your loan payments might be 40,000 so that you have, some wiggle room in case things were to go down a little bit. Also, in this example, where the earnings are 133,000 seller's discretionary earnings, maybe that was a great salary for the existing owner. They started this business from scratch. In the initial years, they didn't make very much, but now they've built up their income to 133,000. And so they're thinking, yeah, this is great. But for that buyer that's going to buy your business and pay 640,000, after they're paying all their loan payments, they're only walking away with a $41,000 salary. So just think about that and put yourself in the buyer's shoes. Would you want to go $640,000 in debt? You'd have to put $64,000 down from your own cash. You'd have to personally guarantee the loan. And then at the end of the day, you're going to make a salary of $41,000. You're going to be working in the business for $41,000. Who wants to buy that job? Nobody. Anybody off the street can get a job making $45,000, $50,000 just doing this work. So why would you want to take on the loan, the stress, the liquidity that you have to put out to buy this? You wouldn't. And so even though the business owner would love to see, the business value of 380 plus the equipment value, they're just, I mean, I can't think of a scenario that many buyers are going to be able to buy this business because the bank won't loan it and they're not going to get a good salary at the end of the day. So now let's walk through the other example of like, if we just do the business for sale for 380,000, which is what I was proposing on the high end. So that's the same SDE, but this time at the end of the day, after they pay their loan payment, they still have plenty of money left. So there's a 1.35 debt service ratio, and their salary at the end of the day is going to be 78,000. So 78,000 is not an extremely high salary, but hey, it's still better than what they could maybe do as an employee. There's opportunity to grow, there's more freedom, they can expand the business, and that starts to be more attractive to take on that risk for a salary close to 80,000. Plus, the bank will actually do this loan because the amount of money left after they pay their loan payment is still enough. So let me just plug in the numbers just so that I can give it to you exactly. So if the loan is for 380, then the cash flow available for debt service is 73,000 and their annual loan payments are 54,000. So they still have an $18,000 cushion even if things start to go sideways. You'll remember in the last example, it was negative 18,000, so that was never going to work. So at 1.35 debt service ratio, this business will likely be able to be financed, and that makes it attractive potentially for someone to buy. So last point, you've seen kind of the math on how it works, but I do want to point out something that I listened to from David C. Barnett. He's a great YouTuber. You should check him out on buying a small business. He has tons of videos on this. And the way he describes it is that a business is a system. So when you're buying a business, you're not just buying assets, otherwise that would be worth 260,000. You are buying, you're deploying capital to have equipment, operating capital, inventory, cash. You're having the stuff you need in the business, plus the people you need in the business, plus where you're operating the business, whether that's online or in a specific location. All of those components added together create the system, and that system is what generates the cash flow. With all of those variables, this is how you're able to generate money. And that is what someone is acquiring. They are acquiring the system. That doesn't mean, so you can just take away this part and just leave them with this, and that doesn't work. They want the whole system so that they can generate the whole cash flow. And, it's, if you think about it another way, it would kind of be like if someone said, well, I know my business is only generating 133,000, but guess what? I have 100 employees. So because I have 100 employees, you should want to buy my business because I have a lot more human capital, more human assets in this business. And any business owner in their right mind is going to say like, well, why would I want a business with 100 employees that only generates $133,000? That's actually a bad thing. I would rather see 3 employees. I'd rather have less to manage than have more to manage and generate the same cash flow. It goes the same with assets, honestly. If you have a very asset-heavy business, that owner is going to say like, okay, well, I have, $300,000 of assets, equipment assets that I'm going to have to maintain, and eventually they're going to break and I'm going to have to replace. So that is less desirable actually sometimes than a business that has $20,000 in assets. Maybe they just have some, a couple computers, one truck, because there's just less complication, less things that can go wrong, less things to maintain. Now, you have to balance that with like, if you have a lot of assets, maybe it's a little bit harder from someone just like Joe off the street to get into that business. So you have maybe some barriers to entry, which is a positive thing. But it's not like a house cleaner where all you need is a vacuum and a rag and some Windex, and then you can call yourself a house cleaner and you've spent, $50 on materials. Anyone can become a house cleaner, so many people can get into that business. There are very, very few barriers to entry to being a house cleaner, whereas there might be more barriers to entry in this construction business because of the asset acquisition requirements in order to run that business system. But it is still a system. So when someone is acquiring it, they are acquiring everything. Also, I get the same question on inventory. Well, I'm a construction company. I have $200,000 in assets. Yeah, that's fine. But I also have $100,000 worth of materials that I need to keep on hand in order to keep my business operating. We order parts every 3 months and we always keep about X amount on hand at all times. And so often people are saying, okay, I want the system price, but give me another $100,000 for the inventory. Nope, it doesn't work that way. Unfortunately, I wish it did for my business sellers out there, but the inventory is part of the system. I always tell my business owners, if that piece of equipment or that level of inventory is standard, is what's required to operate this business system, then that needs to be left within the business when you are selling the business. So the exception being, if you have, say, a piece of equipment that you bought a couple years ago and then you never really ended up using. Maybe it would be smarter for the new owner to just lease that equipment for the one time a year or, one time every couple of years it comes up. Well, in that case, maybe you can exclude that piece of equipment and sell that separately because that isn't really part of the required system. Or say $100,000 of inventory is what's required, but you have stockpiled, $1 million worth of inventory because you bought it all in advance when there were supply chain issues or whatever the case may be. And so maybe you say $100,000 of inventory is required and I'm going to sell this other $1 million of inventory separately, whether that's to the owner or to, the new owner or someone else. So that is why inventory and assets and employees are always included in the business sale. They are included in the business system. So I hope this video helps answer one of these common misconceptions. Don't count on taking, value of the business plus the assets and put yourself in a position where you will have no one that's able to buy your business. Do the math on the loan payment calculator if you're thinking about selling and say, would I want to buy this business for, if I was going to make X dollars at the end of the day? You have to remember as a business seller that the business buyer has a lot of debt that they're taking on, and you might not have had that when you were the business owner. So that's a key component to consider. So thanks for watching. I'm AJ Kohler with First Choice Business Brokers. If you have questions, feel free to reach out to me, and I'm happy to go through questions on a video or talk to you on the phone about the particular scenarios within your business or as a business buyer. Thanks for watching.